Despite what it may feel like, if we step back and look at the bigger picture, many of the so-called Trump trades haven't been delivering the expected returns. That's according to Jerry Minier, co-head of G10 Forex trading at Barclays. The Financial Times wrote that the once popular Trump trade, built on expectations of a stronger dollar and higher bond yields, is already showing signs of unraveling. Investors are taking a more cautious approach, concerned about the economic fallout from Trump's ongoing global trade war. So, what went wrong? At the start of the year, many believed that Trump's economic policies would lead to higher inflation and sustained high interest rates. This assumption drove expectations of a stronger dollar and rising treasury yields. But the reality has been different. Since January, the US dollar has slipped and treasury bonds have rallied, surprising many who had placed their bets on the opposite outcome. Why are investors pulling back? Several factors are at play. One, less aggressive tariffs, as many fear Trump's trade war would be harsher, but his policies have been less extreme than expected. Two, economic uncertainty. The back-and-forth nature of the trade war has left investors uneasy, raising concerns about its long-term impact on confidence in the US economy. Even traditional Trump trades, such as betting against the euro or Chinese renminbi, haven't rewarded investors as they did in the past. Now, as for the US dollar, initially, the belief that Trump's policies would, 1, drive inflation, and 2, limit the Federal Reserve's ability to cut rates fueled a dollar rally. From late September to the end of the year, the dollar surged 8% against a basket of currencies. By December, asset managers had flipped to a net long dollar position, the first time since 2017. But in 2025, things have changed. The dollar has dropped 0.4% so far this year, defying expectations. Now, what about treasury yields? The expectation of higher inflation initially pushed 10-year treasury yields to 4.8% in January, their highest level since late 2023. However, those yields have since fallen to 4.54% as market sentiment shifted. Instead of inflation fears, investors are now more concerned that the strong US economy may start to falter under Trump's leadership. As for emerging markets, which were expected to be major casualties of a stronger dollar and Trump's trade war, they've shown surprising resilience. After a rough 2024, some emerging market currencies are rebounding. The Chilean peso is up over 3%. The Colombian peso and Brazilian real have surged more than 6% against the dollar. Strategists at Bank of America now believe the dollar's rally has been overstretched, prompting them to take a more positive stance on emerging markets. One reason for this shift? Central banks in emerging markets have room to cut interest rates after aggressively raising them in recent years to fight inflation. Moreover, real interest rates adjusted for inflation remain higher in many developing nations compared to the US. This makes borrowing dollars and investing in emerging markets an increasingly attractive strategy. The Trump trade, once a seemingly foolproof bet, is facing cracks. With the dollar slipping, treasury yields dropping, and emerging markets gaining strength, investors are re-evaluating their positions. Will Trump's economic policies reignite confidence, or is this just the beginning of a larger shift in the markets?